Saying that C3 stock has plummeted is probably an understatement. So from the high of $177 a share, stock now trades at around $17 a share. So that's a loss of about 90%. Now, to put that number in perspective, you'd need a return of 1,000% just to break even if you were underwater on a stock by 90%. So we happen to be holding C3 stock and we're underwater on our position. Maybe not as bad as 90%, but it's still pretty bleak. And we're not worried at all. And we're going to talk about why that is. So yesterday, C3 plummeted another 22%, although it's since recovered when they announced earnings. Now, before we get into that, when we look at C3 today, we want to do two things. We want to see that our original thesis hasn't changed, and we want to make sure that the company can survive whatever economic turmoil is around the corner. And you may have seen just hours ago that Jamie Dimon of JP Morgan warned investors to prepare for an economic hurricane. It's quite funny because just 8 days ago, he said that the storm clouds over the US economy may dissipate, and perhaps his indecisiveness is an indicator of how uncertain these times are. So let's talk about why C3 stock dumped 22%, although, as I said, it's since recovered. Now, revenues for fiscal 2022 came in at 252.8 million. Their guidance range was 251 to 252. So that's a sign of a management team that can really execute when they're able to provide guidance that's of such a tight range. Now, they beat the upper range of that barely. So technically, they beat analyst expectations. Next quarter revenue guidance was apparently under analyst expectations, but our focus is always more long-term. So we're interested in guidance for fiscal 2023. That came in at 308 to 316 million. So the lower range of that guidance would be growth of around 22%. That's not bad at all. Now, that's said to be why the market reacted the way that it did. And when you look at the commentary that Mr. Siebel provides in the call, his comments around why the guidance came in as it did make perfect sense. So their target is to generate sustainable positive free cash flow within 8 to 12 quarters. So in the face of uncertainty, where we see the markets are today, that's exactly the sort of language that we want to see coming from company leadership. He said under stable market conditions, he would guide to 30% or greater growth for fiscal 2023. But given current economic and political uncertainty, they're inclined to set the expectations low. Great, as they should. And he says, we're not sure guiding high is of any benefit to shareholders. Now, the market didn't agree with that, and that's perfectly fine. From where we're sitting, we're more interested in the survivability than we are in growth at all costs. And here's the last slide in their earnings deck that looks at the path to profitability, which they're expecting, as we said before, fiscal year 2024 to 2025, where they'll have a positive operating margin. They have a close to $1 billion in cash, which means they made hay while the sun shined, and they have enough money to weather economic turmoil without having to raise capital and sell shares at depressed prices. One comment made in the call was that they were spending on sales and marketing to build their brand, and they're going to be toning that back since their focus now is on taking the existing customers they have and maximizing the revenue that they can get for them. Now, if you're not familiar with what C3 does, I'll put some links to previous articles we've written about the company, probably 3 or 4 that look at various aspects of what they do, whether or not they're artificial intelligence or IoT. We happen to classify them as IoT, although you can easily argue both sides of that. Basically, what they do is predictive enterprise AI. So Mr. Siebel is a tenured executive who built a company and sold it to Oracle, and now he's building the next version of his empire, which has to do with not looking back at historical data, which was around the dot-com times what companies were building. Now it's about having that data tell you what's going to happen in the future. So predicting the future and then changing the future. So that's the sort of platform that C3 has built. In the call, Mr. Siebel talks about how they're being perceived as competing with some of the names that you see here on this slide, when in fact they're partners. And you can see Palantir, interestingly enough, is there, and a lot of names that we're familiar with that we've written about. You've got Snowflake, Databricks, DataRobot, Alteryx, all kinds of names that we've researched extensively. So that was a point that he made during the earnings call, that there's this misconception by investors and customers and whatnot that C3 competes with these various vendors, when in fact C3 brings them all together. And here's a slide that shows an example of that. You can see a deployment they have where various other vendors can be seen: Databricks, Snowflake, DataRobot, etc., SAS, TensorFlow. So C3's software brings everything together, and the strategy of the business is to land, expand. And here's an example of a large integrated energy company where they went from an initial contract value of 300,000 euros all the way to 120 million euros in year 8. And this is that idea, the SaaS idea of net retention rate. Now, Mr. Siebel claims that of the existing customers they have, there's about a 5 to 10% penetration. In other words, there's a lot of milk to get out of the cows they have in the pasture, and that investors shouldn't be looking at the number of new logos added every quarter. Instead, they should be focused more on the expansion within existing customers. Now, that's not to say that C3 isn't growing customers. You can see here that between fiscal 2021 and fiscal 2022, they grew customers quite a bit. Now, we noted in the last 10Q that they revised the way in which they calculate the number of customers. So you may need to keep that in mind. The revisions seem to be around how they accounted for units within a particular customer. So that could be worth looking at. But the point is, Mr. Siebel says, that shouldn't be the focus. It more should be around the penetration of the platform within existing customers. So one of the things that we like to look at when we're considering a SaaS solution is this concept of durability. So I think there's two components there. One is, when you implement, how easy is it to back that out? How easy is it to switch vendors? That's one. And two, does the platform that you're implementing save money or create economic value? And Mr. Siebel made it a point to talk about how Shell got up on stage at a recent conference and was telling all their customers that the C3 implementation saved them $1 billion, let's say, created $1 billion in economic value last year, and will create $2 billion this year in economic value. Now, I want to take a second and talk about this term economic benefit. We've put an example from the earnings presentation here, which shows the utility in Europe that they're working with and the $6.7 billion in annual economic benefit. I would just comment and say that some of these things can be quite vague. So describing, the benefit of, let's say, revenue protection, I suppose you could use cancellation. Some of these bits, grid investment planning, some of these bits can be quite vague. Whereas when you have a solution like UiPath, it's very clear. You had a cost before, you implemented robotic process automation, and afterwards, here's your cost, minus the cost of the RPA. I remember talking to a firm in the UK that built AI-driven routing software for customer service centers, and their price was simply taking a percentage of what they saved companies. Now, that's putting your money where your mouth is. And he said that we've far surpassed whatever fixed cost we had decided on before in terms of pricing, simply by taking a cut of the value created. So when they talk about annual economic benefit, just, you need to consider that. Though with Shell saying that on stage to their customer base, that's certainly a big vote of confidence. Now, we put this slide in here because Palantir is quite popular, and we had written a piece, I'll put it in the description of this video, that compared these two firms. And I think the outcome would probably be that there's so much potential in this $500 billion enterprise AI market that these firms can expand for a decade and never step on each other's toes. That is, if you believe, you say you don't believe Mr. Siebel, who says they're in fact not competitors. But we put this in anyway just to have a talking point. And above there, you can see our simple valuation ratio calculated for Palantir and then calculated for C3. So you could argue that C3 is a better value, or you could argue that Palantir is more highly valued because they have better growth prospects. And then below that, we have the year-to-date return of both these companies. You can see that both have been punished quite a bit compared to the NASDAQ. So we wanted to put that in there in case you had some questions, because when we went long C3, we did so, we were choosing between two firms, C3 or Palantir, and we chose C3. So the only way that you'll be able to judge whether or not the outcome was a success would be when we exit our C3 position. And then we can say, all right, what would we have realized if we were invested in Palantir instead? So moving on to the conclusion, regarding the C3 position we're holding in our 35 tech stock portfolio, we've allocated the maximum amount of capital. So whenever we look at entering a new position, we have a formula that determines how much capital we're going to put into any given position. It's just simple percentage based. Once we allocate that capital, and we do so over time using dollar cost averaging, once we put in our maximum amount of capital, we don't invest in any more. So it's very tempting right now to put in the same amount of money we already have in the position and have our cost basis. That would make us feel good. We could then look at a red number that's a lot less, but that's not how we operate as risk-averse investors. We don't get tempted. We simply say we allocated our capital and we leave it at that. But if we did have more capital, we would have been buying shares of C3 this morning if we had more capital, let's say, to allocate to this particular position. Now, in terms of our usual concerns when we're holding a stock that's underwater, there could be an M&A event that locks in our losses. That seems highly unlikely with Mr. Siebel at the helm, as he will not be selling his company for some bargain price just because the share price is depressed. Then you have the thesis changing. Well, again, going back to the leadership of the company and the talent, it's an extremely selective organization when it comes to hiring. We're going to assume going forward that the thesis doesn't change. They can continue growing revenues, they can continue expanding. And of course, we believe that they're more than capable of surviving. Mr. Siebel operated his own firm through the dot-bomb implosion when Oracle and Intel were 80% below their peak prices and took 10 years to recover. So he's more than familiar with navigating crises. So we're certainly happy that such a tenured leader is leading the company. Now, I'll say one last thing, which is the 10K did not accompany this release, which was odd. So we didn't have a chance to look at things like customer concentration risk, which we hope is reducing over time. It has been historically. And also we wanted to look at industry concentration. So they have a lot of revenues coming from oil and gas. And although they provide color around bookings and industry granularity there, we're more interested in seeing that around revenue. So please put your comments in the comments section. Make sure to subscribe to our channel. And thank you so much for taking the time to watch this video today.